We just had the July FOMC decision. Before we get into what it means, going back to 6 months ago, the market was pricing cuts and now we're talking about hikes. What changed?
Okay, so at the start of 2026, US inflation, US CPI was at 2.4%. Now, the Fed's mandate for inflation, its inflation goal, is to get inflation down to 2%. So the Fed was actually making good progress on inflation, and the thinking was that over the course of 2026, that the Fed would get much closer to target, and make more progress, and that the Fed then could cut rates from the current Fed funds rate of 3.5% by about 50 basis points and take the Fed funds rate down to 3%. So look, what changed? In one word, war. So the conflicts between US and Iran in the Middle East, the consequence from that is that we've got crude oil prices sharply higher. So crude oil was trading around about $60 pre-war, and we've gone as high as about $120. But in the last 4 to 5 months, we've been trading at very elevated levels, around $80, $90, $100. Now, crude oil is one of the biggest components of CPI. So when we get crude oil prices spike as aggressively as what they have, we get a subsequent increase in spike in CPI. And so we saw that in the US. So US CPI went from the start of the year at 2.4%, and in May we actually saw US CPI spike up as high as 4.2%. All the rate cuts that the market had priced in, there's no chance of that happening anymore. And because, yes, inflation is going the wrong way, the market now is looking for Fed rate hikes.
So what happened with the FOMC meeting overnight?
Okay, so yes, we did have an FOMC meeting last night. It was the second meeting that the new Fed chair, Kevin Warsh, headed up. Now, look, the Fed did not move on rates, so rates were unchanged overnight, and it was a unanimous decision, 9 board members to 3 dissenters. But it was what you call a hawkish hike, in that in the press conference that Kevin Warsh gave, he was he reiterated the Fed's commitment to its 2% inflation mandate. And he also basically said that, look, this is not a soft target for them, and that the Fed would achieve its 2% mandate. So look, he's talking very strong on his inflation goals. So basically what the market's priced in now is that the next time the Fed meets is going to be in September. And the market now is pricing in a 70% chance that the Fed will be hiking in September. So look, it looks as if the rate hikes are coming. We're probably just going to have to wait another couple of months before that happens.
So crude is sitting near 85 a barrel with the Strait of Hormuz still contested and war ongoing. Where do you think crude targets for the rest of 2026?
Okay, this is a very important question. What happens to crude next, and what are the end targets for 2026? Because obviously, what happens, with crude is going to affect a lot of other markets, and also obviously affect what happens to the economy. So look, the market certainly wants to know, what happens to crude. But look, it is a very hard question to answer. For the simple fact is that it is a very fluid situation, what is happening in the Middle East. And there's a very good chance that the actors, both the US and Iran, probably don't know exactly how this is all going to play out and finish. But what we can do is we can give some sort of targets for a worst case scenario and a best case scenario. So look, a best case scenario for crude is that the two parties, Iran and the US, get back to diplomacy, and they get back towards the agreement that they had, the memorandum of understanding, where they basically then can open the Strait of Hormuz, and then also eventually obviously make that nuclear deal. If we do have diplomacy working, then yes, we're going to get crude lower. That's going to happen. And crude will probably sell off down towards $70 and potentially marginally below 70. But I believe that we probably still will have a premium above pre-war levels, just for the simple fact is that supply is not going to get back to pre-war levels for an extended period of time, probably not until mid-2027. But look, the war has been going now for over 150 days, and we're no closer to making any deals. Both Iran and the US are back to bombing each other. So look, I would give the best case scenario a very low probability. Now, the worst case scenario is if Iran and the US actually start targeting and bombing oil infrastructure and oil fields. Now, that is something that they've both held off at the moment. But certainly if they escalate and that happens, what will happen is that a lot of this oil infrastructure, if it is taken out, it can take between 3 and 5 years to rebuild. So regardless of whether or not the Strait of Hormuz reopens or not, there's not going to be any oil flowing through that strait. So in a worst case scenario, don't worry about oil going to $100 or going through the highs of 120 that we've made so far during this conflict. We will probably see oil target record highs at 150 plus. So look, worst case scenario certainly is a big risk for the market. But look, I think what we can say with a lot of confidence is that we probably are going to see crude oil trade from here into the rest of the year still at elevated levels, with a potential risk of what we just described, the worst case scenario. So look, yeah, trading crude, certainly, I think you want to be trading it from the long side, and the buyer certainly is to be buying dips.
With crude being so volatile, rather than trading crude directly, which other instruments can a trader trade?
Okay, that's a very good question. Crude has been exceptionally volatile. Even this week we saw it on Monday, it gapped open 7% lower. Last night it was basically back up 7% higher. So it's very hard to hold positions, and especially if you are a smaller trader, almost impossible to hold positions in crude, either long or short. But there are a lot of proxies that you can trade, being exposed to a directional move in crude. So one of the things about crude, obviously, and we've discussed this, that when it spikes up, it is very inflationary. What generally happens then is that we see bond yields higher. And what we've seen so far this year is that US 2-year bond yields have gone up, trading pre-war around about 3.4%. Now they're at 4.3%. US 10-year yields have gone from around 4% up to 4.7%. So we're seeing this huge rise in bond yields on the crude spike. And what happens is that the US dollar basically follows bond yields. So with those bond yields spiking, we have seen the US dollar also rally during this conflict, and we've seen the US dollar trade up to 2-year highs. So if traders want to actually trade a crude move directionally, crude spiking, they can trade the currency market and trade via long USD, which is going to give them a lot less volatility than what being exposed directionally to crude. The other thing is that if crude does start spiking back up above $100 and above 120, no doubt equity markets are not going to be trading at such lofty levels where they are at the moment, and I'd imagine we're going to see some very risk-off trading. So short equity indexes will also work once we start getting crude trading back above 100 and potentially retargeting 120 plus.
Gold is often referred to as the world's ultimate safe haven. Its record high pre-war is 5,600 and currently down 25%, trading at around 4,100. Why did the safe haven trade not work?
Okay, so that's actually a really great question and an interesting question. And I think a lot of the novice traders, beginner traders, have been caught out by this. In that, yes, gold is always recognised as the world's oldest safe haven, and obviously we've got this war going on and bombs flying around, a lot of uncertainty. So a lot of traders, yes, have been buying gold, and it has not worked. And yes, gold has sold off a good 25% during the conflict. And the simple reason for this, again, is crude oil. So crude oil spiking, as we've talked about, it spikes bond yields higher. So we've got bond yields a lot higher, and also central banks have had to raise rates. The thing about gold is that it is a shiny yellow metal. It yields nothing, and also gives you no dividends. The only way you're going to make money with gold is if the price of gold goes up. So when yields are rallying and central banks are raising interest rate, this is something that gold hates. So that's one of the big reasons that we've seen gold lower. The other thing is that gold is priced in USD. So if the USD has a strong rally, that is going to weigh on gold. And what we've seen with those higher US bond yields, we've talked about it, the USD has rallied up to 2-year high. So we've got a strong US dollar. So the combination of those higher bond yields, stronger USD, is the reason why we have seen gold trade lower.
Is central bank buying going to provide a floor for gold?
Okay, yes, I believe there is a floor for gold, certainly, and it will be central bank buying. The reason why gold did trade up to those record highs at 5,600 is because of central bank buying, and especially China. So central banks started buying gold aggressively when it broke 2,000. And one of the reasons they've done that is because they're trying to diversify away from US assets. And so yes, we got that magnificent rally, gold bull run up to 5,600. Central banks have not stopped buying gold, and recently, China, we've seen headlines that they've actually bought a lot more than what the market has thought they have. So look, if gold at the moment is down to around 4,000, potentially there could be a floor, and traders believe around about 3,700 to 3,800 for gold. But certainly the central banks are not looking at stopping their purchasing anytime soon.
We had Q2 Aussie CPI on Wednesday. What did the data tell us to expect from the RBA meeting on the 11th of August?
Okay, so yes, we did have some very important economic data out of Australia yesterday with Q2 Aussie CPI data. Now, the market and the RBA, they watch very closely the RBA trimmed mean. Now, in Q1, the RBA trimmed mean came in at 3.5%. Market was expecting that to go marginally up to 3.7%, and it came in just below expectations at 3.6%. Now, for the headline number, market was expecting for Q2 to be pretty much on par with Q1, which was at 4.1%, so no real change. But the number actually came out a touch lower at 3.9%. So both on the RBA trim mean and also the headline number came in just a touch below expectations. So look, the market basically had a big, it was a relief for the market. And so what does it mean for the RBA, which has already raised rates 3 times this year, that in the August meeting on August the 11th, that they're going to be on hold. So, but that does not mean that the RBA may not hike again this year. Obviously, we're going to have to see what happens to crude oil.
AUD USD is sitting near 70 cents. How much of that is the RBA and how much of that is the US dollar side of the pair?
Okay, so the RBA was the first central bank that started raising rates this year. RBA has actually raised rates 3 times this year, taking to the cash rate of 4.35%. So that was a huge tailwind for the Aussie, which actually took the Aussie up towards 73 cents for the highs for the year. Now, But then obviously we had the war start, and what's happened with the war, if we've described, is that the USD now has been very dominant in the currency market. It's trading at 2-year highs. And so now that has weighed on the Aussie and taken the Aussie back down to 70 cents and just below. So look, what happens next with the Aussie is obviously going to be dictated by what happens to with the war, and whether or not it escalates, and whether or not crude oil continues higher. If that happens, obviously it's going to continue to weigh on the Aussie, but if somehow diplomacy comes through, then the Aussie will fly topside.
Between the event risks of the Fed, the US midterm elections in November, and whatever the Middle East does next, what is the one thing that worries you that the market is underpricing?
Look, I think the thing that basically keeps me up at night and worries me is what is going on with global debt. If you have a look at the US, they've now got record debt that's tripped $40 trillion and continues to grow. Here in Australia, we've now got record debt. We've just reached $1 trillion. But look, it's not just only sovereign and government debt. It's at every single level of the economy. Have a look at corporate debt as well. The money that's being spent on AI, it's hundreds of billions of dollars. A lot of that is obviously coming from debt. And households as well. We've just had record house prices, so households have got record size mortgages and big debt as well. So look, every single level of the economy has got massive debt. And so look, at some stage, the bond investors, the guys that are basically holding up and basically giving the money for this debt, when they look at the maths and say the maths doesn't add up, they are going to demand a bigger premium, so higher bond yields, to keep buying those bonds. If we have a look at the moment, what's happening in the US 30 years, we've just got to 5.2% on those bonds. That is a 20-year high. So we're already starting to see, and we'll have a look at the US 10-year yields, they're around about 4.7%, pushing up towards 5%. So slowly we are actually seeing these bond yields spiking up, and what will happen is the debt holders, obviously it's going to be more expensive for them to service that debt, and at some stage the defaults will start, and once the defaults start, it could cascade throughout the economy. But certainly, this is what I believe will cause the next market crash. So look, obviously it's not going to happen overnight, but at some stage market will focus on this, and it's just a matter of time when this happens.